Hello, everyone. Thank you for joining us for our investment commentary and year-end financial planning updates. My name is George Padula, Co-CIO here at Modera Wealth, and I want to thank you for joining us for this hour. I am joined with my colleagues in our various offices. Sarah DerGarabedian, she is Director of Investment Management. She's out of our Asheville office. Bill Hansen, also Co-CIO. With me, heading up investments, the investment team here and research. Bill is also out of our Asheville office. And then Judd Meinhart, who is Director of Financial Planning for Modera Wealth, and he is out of our Winston-Salem office. We've got a full agenda today. We've got some tremendous questions from all of you. And we are going to kind of go through some investment commentary first. We're going to hit some year-end, really high-quality investment financial planning topics and reminders for the year-end. And then we've got some additional Q&A that we'll go through. This webinar is being recorded, and we will get out the recording to you afterwards, as well as if we don't hit all the questions that you may be putting into the chat, or if we haven't hit your question along the way, we'll certainly be able to get those answers out to you. So why don't we dive right in? We've got a full agenda here, and really we want to talk about kind of what's the investment journey. It's been really interesting several years, and we all know that when we think about investments, it's not simply just an end point. It is a journey. It's not always clear skies or calm sailing, right? There's some stops and starts, some ups and downs. I've been doing a lot of traveling with family, visiting our different offices, and you think about all the time you spend in airports and on the road, you hit potholes, but there's smooth pavement. We really want to think about what's not only what's happened in the past, but really where are we going forward? Because we don't really think about investments as investing through the rearview mirror. We think about investing moving forward. So what's the journey looked like going forward? So if we could go to the next slide, perfect. Here's where we were at the beginning of this year, right? So 2022 really was a tough year. Interest rates were going up tremendously. First half of 23, almost a mirror image, right? And so you can see from this slide here, the blue lines were the first part of 23. The orange lines were the last part, were all of 22. It really was just a mirror image. What have we seen since the end of June here? Next slide, please. Certainly, we've had some ups and downs. As of the end of September, the S&P 500 up about 11.5%. International developed markets up about 4%. We've seen a strong dollar recently, and there's certainly been some geopolitical issues ongoing overseas. Value stocks, large cap up about 5.3%. Small caps are down slightly, and it's the first part of the year. Certainly, U.S. aggregate bond index on a price basis has been down. So we've had a really strong first part of the year, a little bit of a slowdown here in the second part of the year, but that's really kind of the short term, right? So we're in a little bit of a kind of a traffic-y situation here. But if we kind of think about what the longer term road ahead, we think about what our mapping looks like. I want to look at what the year looked like, 3 years, 5 years, 10 years. If we could go to the next slide, please. Here's where we are, right? So if we think about the U.S. large caps, S&P 500, up about 13% over the last year, up about 19%, almost 20% for the last 12 months. But what's interesting is despite everything that's gone on in the last year, year and a half, even 3 years with COVID, we look at where the 5 years are and the 10 years are. U.S. large caps have averaged almost 12% annually for the last 10 years. We've had a really rough go with bonds. As we know, interest rates are going up. And when interest rates go up, bond prices come down, right? It's that inverse relationship. But what do we think about with bonds? It's not just treasury bonds, but it's also corporate bonds, it's municipal bonds, it's global bonds. And we can see whereas the U.S. aggregate bond index is down about 1% on a total return basis. So there's a price difference, and then there is the income that you receive from bonds. But corporate bonds up about 6% over the last 12 months. Global bonds down about 2%. But if we think about where we are over the last 5 and 10 years, well, we've had a tough go with treasuries and intermediate bonds. Municipal bonds have averaged about 2.3% annualized. Corporate bonds up about 4%. Real estate, a lot of talk about real estate. Real estate's been averaging about 3% over the last 10 years. And as well, we think about this type of investing, it's really about diversification. You're never going to be in one asset class. You're never going to be in one type of investment forever, or in the totality of your portfolio. And as Bill and Sarah talk about in their sections, and Judd talk about it, it's the totality of the planning and the investment strategy that you really need to think about. There's been a lot of headlines recently about just the concentration in stocks, and we'll get to that. I'll show you a couple of slides here, but I did want to just make a mention of bonds, because certainly we are in a situation where interest rates have gone up tremendously over the last year and a half, and the question is really, where do we go from here with bonds? So let's take a look longer term with our bond market. You can change the slide, please. Bond index, when we think about bonds, we think about the Barclays Aggregate Bond Index, right? So that's the overall intermediate bond market. And if we look at this slide here, and we use this slide from one of our research partners, JP Morgan, they took the last 47 years of the bond market, and they just said, how did the bond market do in each year, right? And we look at the last 47 years, and you can see where we are year to date too. Bond market's been positive in 42 of the last 47 years, almost 90%. So the gray bar represents the return of the bond market over that period of time, that year. The little red dots are the intra-year return. So you can have ups and downs during the year, and that's the intra-year return. So even in a positive year, you'll have some negative returns. If you go to the far right of that chart, what you do see is you see 2021, 2022 negative, and here we are a little bit in 2023 negative, right? So interest rates have gone up, bond prices come down. There certainly has been a little bit more of an interest rate increase, and it's faster than people perhaps had expected. Fed is doing this in order to reduce the inflation factor that's been built in as of COVID. So what do we think about, right? We just certainly don't want to abandon bonds, and we certainly don't want to put everything into just one asset class. But when we think about bonds, and we'll talk about this a little bit later too in the Q&A, we really think about quality, right? We want good quality in our bonds across the board, treasuries, corporates, international. We want good diversification. That includes municipal bonds, international bonds, shorter term, longer term, intermediate term bonds. We typically keep our duration, which is a measure of risk, a little bit shorter than the aggregate bond index in order to mitigate some of those rising interest rates. And then we certainly diversify. So again, the aggregate bond index is really a lot about the US intermediate, heavily weighted treasuries. And we have municipals, we have international, we have corporate bonds across the board, we have in our portfolios. So we want to really focus on those key things, right? Credit quality being high. We want to get good income. We typically have a little bit higher income here than the aggregate bond index. We diversify more, and we keep our risk management here. So the bond market's really been unique, and there's a lot of talk about where the bonds are going. The other thing in the headline, and we've gotten a lot of questions on, is, well, what about the concentration in the technology space? Certain companies, just a few companies, seem to be driving the returns. So we look at the next slide here. So we're talking about bonds, talked about kind of filtered down here. We looked at the aggregate indexes. We looked at bonds. The next question we got really was about what's going on with what we'll call the Magnificent Seven. Great movie. And even, these companies are fantastic as well. So we think about the top 7 companies in the S&P 500. S&P 500 is a good benchmark for the largest companies in the country, ranked by their market capitalization, ranked by size. So right now, those include Apple and Microsoft, Meta, which is the company that makes Facebook, Amazon, Alphabet, which is Google, NVIDIA, which is a technology company, a semiconductor company, and Tesla, the auto manufacturer, right? So all of these lines, maybe it's a spaghetti line here, represent what the returns look like for each of the companies, each of those 7 companies, over the last year-to-date period. Incredible growth, right? And they've well outperformed the index itself, right? If you average all of these, right? Apple seems to be, the worst at plus 34% return. NVIDIA up almost 200%. If we average all of those, they're up on average about 80-something% year to date. Looks tremendous. Question is, why shouldn't anyone be in just those, right? Well, I will tell you, we own those. You own those in your portfolios. You have them as part of the indexes and as part of the investments that we have within the portfolios. But every time you have that return, you have to think about the ups and downs. Remember what I mentioned at the beginning, those potholes, the stops and starts. So while they're doing really, really well this year, let's see what they did last year. Last year, Apple up 34%, negative 26% last year. Microsoft negative 28, Facebook negative 64, all the way down. Tesla down 65. Not a lot of long distance there with Tesla, right? You average those up last year, you're down about 50%. If we do the math, if you're down 50%, you have to be up more than 100 in order to break even. So down 50% last year, up about 80% this year, you're not even back to break even. So again, the headlines are showing, and the technology companies are doing tremendous. You got to take the step back, and you really have to think about what's the journey you're taking in order to get there. And really, while these companies are magnificent, they also have a situation where you have to really kind of make sure you understand what you're getting into, have them as part of the diversified portfolio, have them thinking about within the context of the overall investment strategy. Just as you can think about the bond market, whereas the bond market is down this year and it was down last year, history shows you don't want to get out of that when things are down like that. A lot of headlines out there. And so the next step is really kind of thinking about how do we translate that into investment strategy moving forward. So I've given you kind of the background of where we are. I'm going to hand it off to my colleague, Bill, who's going to start talking about the strategy moving forward. Bill, take it away.
Great. Thanks, George. So here's a graphic that kind of highlights important parts of our process. And we want to be diversified geographically. We want to be diversified between U.S. and international investments. We want to be diversified among different size companies within our stock portfolio for our clients. And we also want to be diversified between all the economic sectors. So if you think about it, those last couple slides that George showed on concentration, our client portfolios are actually better diversified than the S&P 500. The S&P 500, the top 10 companies are about 30% of the index. The top 2 companies are about 7% each. So our portfolios have a small tilt towards smaller size and towards less expensive or value compared with the overall market. And the way we achieve that is essentially by kind of taking a little bit away from those larger companies and then using that to expand that universe of investments. And so we never know what is going to do better for sure. Like you might have a thought, maybe US is going to do better than international or vice versa. And things like that go in cycles. We always want to have exposure to international investments. Over the last 2 years or so, developed international has actually done a little bit better. But for over 14 years before that, the US did better. So you never know for sure. We always want to reduce risk. We always want to be globally diversified, large, medium, small, international, US, and then all economic sectors. And then within the bond portfolio, we're also well diversified. George talked a little bit about that, and we'll have a little bit more info on that in the Q&A section. So I want to move on from kind of portfolio strategy onto a couple slides on economic data. So this first one is on what's called the inverted yield curve. So there's been a lot of talk, a lot of concern about a potential recession. And so the question is, with all these interest rate increases that we've seen, will this slow the economy enough to push economic growth negative, at least for a couple quarters in a row? So this slide is actually from the government website. This is your tax dollars at work. This shows it's a free website that we all pay for. This shows the difference between the 10-year Treasury rate and the 3-year Treasury rate. So you can see that short-term interest rates are currently higher than long-term rates, and that's called an inverted yield curve. Normally, we would expect longer-term bonds to have higher rates since you're tying up your money for a longer period of time. So this current inversion that we're experiencing started back in November of 22. It's still in effect. It's just not as negative as it was. We had a big move in the 10-year Treasury. 10-year Treasury's gone from about a 4% yield to just under 5% since early August. So that's, and short-term rates have remained flat so far. Fed is actually meeting as we speak. We'll find out this afternoon at 2:05 p.m. from Chairman Powell if there's any change to short-term rates. One tool you can look at to see what the market's expecting is called FedWatch. It's the Chicago Mercantile Exchange. It gives you the probabilities of, is there no change? Is there an increase? Is there a decrease? When I was in grad school, we used to do this. It uses Fed funds futures. We would do it like with a paper Wall Street Journal and figure it out. But now somebody's got a website. So I took a look yesterday. It showed 97% probability of no change with a slight possibility of a cut. So I doubt there will be a cut, but in any event, our view is that we're nearing the end of the rate hikes. So why is this inverted yield curve a big deal? Well, historically, it's preceded recessions, and you can see recessions on this chart delineated by the gray bars. When you see the yield go below that black line, it's preceded the gray bar. So you got an inverted yield curve, you get a recession, is what the kind of the fear is. We switch to next slide. So are recessions unusual? Not really. We've experienced 11 since 1950. On average, they've lasted about 10 months. You can see the vertical bars on this are the recessions, and all the rest of the time is expansion. The economy is expanding. So you've got a lot more expansion than contraction. And currently, we just got a report on second quarter preliminary economic growth. It was above consensus. And then fourth quarter GDP or economic growth is estimated at about 2.3%. That's from Federal Reserve Bank of Atlanta. They have a cool tool called GDP Now. You can look at that and see what the expectations are. I find they tend to run like a little bit high, but they just give you one number. It's real easy to find. And the other good news is over the course of the year, if you look at the consensus of all the economists, their expectation for GDP for the year has been increasing throughout the year pretty steadily all the way back to January. So we've got economic growth. In third quarter, we've got projected economic growth in the fourth quarter. Some are predicting a recession in the first and second quarter next year. But at the same time we have economic growth, the economy's at full employment. So unemployment's under 4%. Those numbers will come out Friday. The last one I saw was 3.8% for September. So that's pretty much full employment. And the Bureau of Labor Statistics also came out with what they call the JOLTS report. That showed, it was interesting, about 9.6 million job openings compared with about 6.4 million unemployed people. So we're at full employment and we've still got, considerable job openings out there in the economy. So while there's going to be a recession at some point, we don't know exactly when. We're going to experience in our investing lifetimes a lot of recessions. It's just kind of part of the process. We really don't believe that that's something imminent. It's just hard to have a recession when you have both economic growth and full employment simultaneously. So that's a couple snippets on the economy, and I'll pass it over to Sarah, and she'll talk a little bit about the road ahead.
Thank you, Bill. I think somehow I got stuck with difficult part. I will do my best. If we could flip forward for a minute, thank you. So many of the questions we received in advance of the webinar were asking us for predictions of what might happen to the markets the economy, or your portfolios in light of various domestic and international political events and conflicts. So first, let's talk about predictions. Bill was talking a little bit about, some of the probabilities and predictions, and everyone wants to know what we think is going to happen. So I don't know if you're familiar, but there's a man named Philip Tetlock. He wrote a book about super forecasting, the art and science of prediction. And he says that most people cannot beat a dart-throwing chimp when it comes to making accurate predictions. And this is no offense to chimps. We're all just, primates doing our best. But while he says, there are a few situations where you can improve your accuracy, there's also the environment itself has some degree of irreducible uncertainty, no matter how good you are, how smart you are, how much you know, or how confident you sound. So when it comes to predicting how a particular event will affect markets and portfolios, my colleague Bill likes to refer to what he calls the one-step removed problem. So even if you could accurately predict a particular event, like the outcome of a presidential election, which is on a lot of people's minds right now, it's very unlikely that you could actually predict what the market will do in response. You'd have to be right about every single outcome in a long string of events, including the unknown unknowns, as Donald Rumsfeld liked to call them. And the probability of getting it right is really next to zero. Here's the good news, though. You don't have to get it right. So if you look at this chart, what you see here is the growth of the S&P 500 index from 1926 to 2022 under a variety of different presidential administrations. And there are obviously fluctuations over time, and you'll see, though, that the trend is consistently positive, with the exception of poor Hoover back there in the 30s. Other than that, consistently positive. So let's flip to the next slide if we can. Okay, so here we see a more granular depiction of the S&P 500 index returns during both election years, which is shown in blue, and the year after the election, which is shown in green. So the first thing that jumps out to me, at least, is how many more of these years have positive returns than negative. The second thing you might see is that the negative years can usually be attributed to events that are really outside the scope of the presidential election itself. Overall, average returns for election years over this time frame are around 11.6%, which is slightly above the long-term average return of the S&P at about 10%. Here's something interesting. So I read an article in the Wall Street Journal this morning, and it was asking, why do Americans have such a negative outlook on the economy when the numbers are objectively positive? And like Bill was talking about, the article notes that economic output is above where it would have been if the pandemic had never happened. The unemployment rate is almost exactly where it was in January of 2020 at around 3.8%. So the consumer's consuming, but their confidence is terribly depressed. People are often citing inflation as the reason, but even that's come down significantly to around 3.7%. The author concluded that some of the pessimism about the economy is really a reflection of our overall unease with both domestic and global crises and conflicts. So let's take a look at some of the events of the past 50 years and see how they stack up to market movements. Thank you. All right, so current global conflicts are top of mind for everybody right now, including all of us here at Modera. We've received several questions from clients asking how we think these events will impact their investment portfolios. Once again, it's really difficult, if not impossible, to predict the events themselves, much less how they may or may not impact financial markets and our own investment portfolios. This slide here demonstrates a similar relationship as the one we looked at a couple slides back, but this one is showing the MSCI World Index from 1970 to 2022 against a backdrop of the many global crises and conflicts over that time frame. Once again, despite volatility along the way, the trend is consistently positive. So the market may react negatively in the short term, but it's been remarkably resilient over time. This isn't meant to minimize the impact of global conflicts on people or the human suffering that results from them. But from an investment perspective, at least, it's important to zoom out, to look at the long-term trends, and to stay invested and diversified, like George was referring to at the top of the program. We're going to talk more about those aspects of our investment philosophy when we get to the Q&A, so I'm going to leave it there for now, and I'm going to hand it over to my colleague, Judd Meinhart, our Director of Financial Planning, who's got some very timely and actionable year-end tips and reminders.
All right, thank you, Sarah, and thank you, George and Bill. Collectively, we all value and appreciate your insights, and I think you all do much better than a bunch of dart throwing chimps. My name's Judd Meinhart. I'm an advisor in the Winston-Salem office. I'm also the Director of Financial Planning here at Modera Wealth Management. And in part of that role, what I do is try to support our advisors to ensure we're delivering to you the best recommendations to help you meet your financial goals. And along those lines, we're here to kind of wrap up some year end, talk about tips and deadlines. I know year end can be quite a frenetic time of year. As the dad of two young boys myself, we just packed up the Halloween costumes. They're already on to writing their Christmas lists. Halloween, the year end's filled with like the holiday celebrations, spending time with families. It's also an important time of year to make really important decisions regarding finances. One of those seasons that is already open is open enrollment for Medicare. If you are retired or you're already on Medicare, that season kicked off 2 weeks ago, October 15th, and you have a little bit more than a month and a week left to make final decisions regarding your 2024 Medicare coverage. So, especially if you're new to Medicare, you want to orient yourself. Not all healthcare providers do accept Medicare coverage. The worst thing you want to do if you're going with a traditional Medicare route is to go to your annual physical in January and find out that your primary care physician does not accept Medicare. So take a look at your list of current providers, especially if this is your first time enrolling in Medicare. Along those same lines, review your Part D for formulary changes. If you are currently on any prescription medications or discussing those with your physician, Part D is what covers prescription medication, and Part D plans are not standardized. They're provided by private medical insurers, and they all contain different formularies. So please check those to ensure your prescriptions are covered. And formularies also change from year to year. So even if this is your first or your 50th time enrolling in Medicare, it's important to check up on your Part D formulary. Third, if you go the traditional route of Medicare, meaning you're enrolling just in regular Part A and Part B, you may want to consider a Medigap or a Medicare supplement plan. What are these? These are additional plans that can help you limit your out-of-pocket costs with Medicare. Because Medicare likes to keep things confusing, they also label these in an alphabet soup fashion with Plan A, Plan B, Plan C. And these plans are all standardized by state. So I know here in North Carolina, you can log on to the North Carolina Department of Insurance website and find a nice cost comparison tool and coverage tool to compare different Medigap plans. Just the other day, I was looking for a Plan F for a client, and I found costs that ranged all the way from $115 a month up to $350 a month. These were for the same exact coverage. Okay, so different insurers will charge a different amount, but it's for the same coverage. So if you do have a Medigap or a Medicare supplement plan, it's important that you do shop around for it. Now, if you prefer Medicare Advantage plans, which is kind of the whole health insurance wrapped into one, it covers your hospital, your primary care physicians, your Part D, sometimes even vision and dental. You have a little more leniency on your deadline. You do have until March 31st to make changes to that, but it is important that you do enroll so that you do have coverage on January 1st. And moving on, we also have for early retirees who are looking for insurance, or if you're self-employed, through the Affordable Care Act exchange. That open enrollment season kicked off today. Today's the first day you can log on to healthcare.gov and start shopping around for a healthcare plan. You have until January 16th to elect your coverage, but if you want January 1st coverage, you must make your decision and enroll by December 15th. One of the big mistakes I've seen folks make is as you go through that questionnaire, they will ask you to forecast your next year's income. And it can be tempting to kind of shoot low, because the lower your income is, the higher your premium tax credit will be, meaning the lower that you have to pay on a monthly basis for that health insurance. But if you do estimate low and your income comes in higher in 2024, you will have to pay back a large portion of any subsidies you get in April 2025 when you go to file your taxes. So it's important to be realistic about what potentially you will earn in the coming year to avoid those types of surprises. And then lastly, if you're like me and still working for a paycheck, you rely on your employer's healthcare coverage. So be sure when open enrollment season does come around for you to take a look at current benefits. Make sure you're maximizing tax deferral opportunities through 401ks, flex spending accounts, and health savings accounts. And also take a look at any changes that have happened in your life that might necessitate a change in life insurance choices or short or long-term disability coverage that your employer does offer. And of course, this is one of my favorite tools that we've developed, being a golfer myself. Check out our golf course guide to Medicare. It is a full 18 holes chock full of tips, tricks, birdies, and bogeys on your Medicare coverage. And you will not, hopefully it doesn't take you 4.5 hours to get through it. No slow play on this one. So check that out. It is on our website. And moving on. So important reminder here, we are focused on year end. Not all deadlines are year end. So calendar year deadlines, December 31st, important to know, include employee contributions, both if you are covered by an employer's 401k or if you're self-employed and have a solo 401k. This also includes your catch-up contributions. So limits on those are $22,500 and $7,500 respectively for 2023. So you want to make sure you're maxing out your employee contributions to your 401ks before year end. Likewise, with Roth conversions or charitable contributions and required minimum distributions, those must be out of your accounts by December 31st in order for them to be credited for the current tax year. Now, just my plug here for our wonderful client service team. We don't want to be waiting until December 31st to make those types of decisions, especially when we have to place trades, raise cash. There is a lot that goes into moving money around, especially from one account to another, or sending it out to a charity. So we encourage everyone to make those decisions by December 1st. And at the absolute latest, December 15th, we should have the ball rolling on any type of year-end contributions, conversions, or distributions. That's going to ensure that we don't run over that deadline or miss that December 31st deadline. Now, not all deadlines are year-end, right? We have a few April 15th, or more accurately, tax day deadlines. So IRA and Roth IRA contributions are an April 15th or a tax day deadline. Employer contributions to your solo 401k are also a tax day deadline, along with SEP IRA contributions. And if you fail to max out your health savings account contributions by year end, you can always make those contributions for the previous year into the new year. If you do extend your tax return and you're on the April or the October 15th deadline, you may have some extended time to make some of these contributions as well. You'll want to consult with your tax preparer or CPA on those to confirm what deadline is appropriate for you. And of course, speaking a little bit more to the required minimum distributions, we had some big changes last year. I know one entity that does like to wait to the last minute is Congress. And last year on, I believe it was December 29th, they passed Secure Act 2.0 because Secure Act 1 was not enough for us. And that contains some big changes to required distributions. So if you turn 72 this year, you actually got a brief reprieve from having to take required distributions from your IRAs or 401ks. Those, your required beginning date will now be next year when your RMDs will commence. So you can see if you were born between 1951 and 1959, the year that you turn 73 is the first year that you will be subject to a required distribution. If you were born 1960 or later, you actually have now until age 75 to take those distributions. So it's important to know when those required distributions commence. If you do not get your entire required distribution out of your IRA or 401k by December 31st, you are subject to a penalty. Secure Act 2.0 actually lessened that penalty a little bit. It used to be 50%. Now it's only 25%. There also is a corrective window that extends for 2 years beyond the year that the RMD was supposed to be processed. And if you do take the distribution within that corrective window, the penalty gets reduced down further until 10%. All right, now all of this comes with a big asterisk beside it, right? In the first year that you have to take an RMD, so if you're turning 73 next year, you technically do not have to take your RMD until April 1st of 2025. Now, this is not a strategy that we generally recommend to clients. Why is that? Because in 2025, that means you have to take your previous year RMD and your current year RMD. So it's almost like an RMD times 2, which can really wreak havoc on your tax planning. So speak to your advisor. The strategy might apply to you, but I will say in most cases, it does not. Okay, on to some more lighter-hearted things. I think when we speak about charitable giving, we always say giving should be decided by your heart, but how you give should really be determined by your tax situation. So if you are over the age of 70 and a half, you should consider QCDs or qualified charitable distributions. Generally speaking, these are the most efficient way to give to charity if you are eligible to do so. What a qualified charitable distribution is, you take money directly from your IRA and send it directly to that charity. It cannot stop off in your checking account and you write the check. This is a strategy that we execute for a large number of clients. And if you're thinking about giving charitably, I suggest you consult with your advisor to see if it's a wise decision for you. Another strategy that makes a lot of sense for clients is to leverage a donor advised fund. What a donor advised fund is, it's a specific type of account that will accept charitable contributions from you, but you are still maintain the ultimate control over those funds on when they are distributed to the charity. So the reason why we leverage donor advised funds, if you're a regularly charitably inclined individual, say maybe you give away $5,000 a year to church or a list of charities, what we've been advising clients to do is bunch together a few years worth of deductions, say 5 or 6 years, make one large contribution into that donor advised fund for $30,000 and parcel out those distributions over the next 5 years. What that allows you to do is allows you to take the charitable deduction all in 1 year, in the current year you make it, which will likely exceed what your itemized deductions would have been. So you get an added tax benefit to your charitable giving in this case. Again, strategy is not appropriate for everyone. Check with your Modera wealth advisor. And then gifting appreciated securities. if you are a holder of one of those magnificent sevens, maybe you bought them on January 1st, and you do have the 200% appreciation in NVIDIA, and it's too much of your portfolio, you don't want the risk, right? Gifting appreciated securities is a great strategy to avoid the capital gains taxes on that as well. So, and just a plug for Giving Tuesday, after all the Black Friday shopping is done, November 28th is when you'll start to see all those charitable giving advertisements, appeals. And again, we want to make sure that we're executing charitable giving in a timely fashion so that any gifts we're making are out of our accounts by that year-end deadline. So December 1st is a great time to start those conversations with your advisor. All right, and finally, gifting to family. Typically, when we think about estate planning and gifting, we're thinking about individuals with very high net worths. The current lifetime gift tax exclusion amount is almost 13 million per individual. So for a married couple, that's 26 million, almost 26 million of wealth that you can pass to future generations without incurring any type of federal estate tax. All right. State limits might be a little bit different, so you definitely want to consult with your attorney in that fashion. But if you are in the mindset of you don't want to wait for your beneficiaries to enjoy that inheritance, you would like to see them, whether it's funding college for an individual, for a grandchild, or another means helping support for a down payment for a house, you can gift on an annual basis up to $17,000 per person. So what does that mean? If you are a married couple and you want to support one of your children, each spouse could give $17,000 per person, or $35,000 per gift. That will not eat into your lifetime gift tax exclusion amount, provided you stay below that threshold. Again, you can make an unlimited number of gifts to an unlimited number of individuals, right? And if you are a married couple, you can multiply that by 2. Again, we do advise annual gifting as an efficient way to transfer wealth. And again, consult with your advisor. I feel like a broken record on this one, but your individual circumstances, are unique to you. And that's part of the role of having a wealth advisor, is to understand what your individual goals are and how to execute the best strategies to achieve them. So I know we've ran through a lot, and I know we have a lot of questions to answer. So I'm going to kick it back over to our Co-CIO, Bill Hansen, to dig in.
That's great, Judd. Thanks. That was a lot of good info. I had to grab my legal pad and jot down some notes. So yeah, we're going to get to a few questions. We thank those of you who submitted questions in advance. We want to know what's on your minds. And when we get questions coming in, we group them into similar themes, and then we try and address them either in the webcast itself or directly at the end. So if something comes up, chat it to us. If we have some time, we may take a couple more questions at the end. Otherwise, your advisor will circle back with you next week. So question number 1, and this is one we've heard, there's a couple of variants of this, but we've been hearing this more than once. It's an excellent question. Given the volatility of the current stock market, should I be exiting current stock positions and moving money into a safer environment, such as money market or bonds, until we see more stability? Or the variant to this, with treasury rates near 5%, why shouldn't I just sell all of my investments and buy treasuries? So great questions. It kind of brings up a number of layers. I was talking to George about this, and I said, George, this is a great question. I could probably talk for 20 minutes on this. And he said, please don't. Just, give him the basics. So let's take a look at our investment philosophy. I'm not going to read this slide. I want to focus in on a couple other things, but I just wanted to put this up there. This is a little bit more in depth on Modera's philosophy. But it's easy to get spooked after a year like 2022 when both stocks and bonds were down. So I want to go back to the 3 pillars of our investment philosophy, which are no market timing, broad diversification, which we talked about before, and investing for the long term. And what do we mean when we say investing for the long term? What we're really talking about there is maintaining a fixed asset allocation or a fixed mix of assets and then rebalancing around that mix as market conditions change. So your asset allocation and sticking to it, that's going to determine most of your investment returns. If there's one thing that you take from this presentation, I hope that that's it. So within that allocation, we're going to do the best job we can on the research side to select and allocate to low-cost, globally diversified investments. So that allocation decision, part of it is math or science. We have really good financial planning software and really operated by really good financial planners that Judd leads. Part of it is science and has to do with required rates of return and expected returns and things like that. And then part of it is behavioral or emotional. So it's important that you work with your advisor to select that asset allocation that suits you, that you can stick with, through all the ups and downs. We don't want to get greedy at the top, and we don't want to get fearful at the bottom, or fearful even times like now where we have crazy geopolitical stuff going on. So making a big shift out of other investments into treasuries would really violate all three of our pillars. So the short answer is no, we would not recommend a change to your asset allocation. We just say maintain that chosen allocation, let us rebalance around it when investments have moved enough. Within the investment portfolios, we have all kinds of targets that the software is tracking, and we're constantly looking for our portfolio manager constantly looking for opportunities to make improvements to portfolios. So we can also go one layer deeper in this question. We can talk about a couple different types of risk. So whatever your mix of assets, you're always taking risk. There's kind of a perception that treasuries are risk-free, and that's true in the sense that they're free from the risk of default. But it's not really true in other senses. So right now you've got the yield curve is right around 5%, let's say, all the way out to 30 years. And the treasury market's pricing in inflation of about 2.5%. So you sell everything, you buy long-term treasuries, you lock in 5%. Let's say inflation comes out higher than 2.5% over the next 30 years. That puts you in a really bad situation. Another potential pitfall of the selling everything to buy treasuries or selling a bunch of your stuff to buy treasuries has to do with your required rate of return that you need to meet your financial goals. And this is something that our financial planning software can help determine. But for many of us, 5% might not be sufficient. In that case, you need some stocks or you're going to run out of money for sure. So that's a tough situation to be in. And so regardless of what your kind of behavioral emotional makeup is, we would say that you need some allocation to stocks. In other words, rising earnings, rising dividends to offset inflation over time. So it is an interesting conundrum where we've got, I can get 5% on a money market, or I can get 5% on a 30-year treasury. So there's also risk in money market or short-term treasuries at 5%. What's that risk? Well, it's that rates go down and then you can't reinvest at that rate anymore. And yields, the way the treasury market is priced right now, it's telling us that the expectation is that rates are going to go down somewhat in the future. So we've got risk of long-term treasuries is unanticipated inflation. Risk of short-term treasuries is rates go down, you're reinvesting at a rate that doesn't meet your return requirement. So we've still got risk in treasuries, whether they're short-term treasuries or long-term treasuries. And it just so happens that they both yield about 5% right now. So we do think that having treasuries and other bonds as part of a diversified portfolio makes total sense. And a couple of reasons behind that are, George talked about this earlier, provide current income, and then more importantly, serve as a source of spending when stock prices are lower. Historically, stock market's typically up 7 out of 10 years. During those down years, you want to have a pot to pull from, the income plus some fixed income or ballast in the portfolio. And sometimes those bonds can go down. They go up more than, they have positive returns more than negative, but as we saw last year. But you want to have that mix of assets to have something to pull from when stock prices are lower. So why are we so against market timing? Let's go to the next one. This is a fascinating slide. I've seen this done a couple different ways, but market timing, avoiding it is so important that we put it in as one of the pillars of our process. And like the short explanation is, it's because you never know when the market's best days are going to happen. Sometimes it's during a bear market. Sometimes it's right at the beginning of a bull market, except you don't know it's the beginning of a bull market yet. And being out of the market for just a few days can really handicap your returns. So volatility, or that bouncing around, it's uncomfortable. I don't like it either, but it's just a normal and expected part of investing. It's the price you pay for more money in the long run, is you have to endure the turbulence in the air. So what this chart is showing us is the S&P 500 over a 32-year period. For those of you counting, that's about 8,000 trading days. There's about 250 trading days in a year. So if you miss the best 15 of those 8,000 days, you end up with about a third of the money. So you just have to be in it all the time. You just can't predict when the market's going to go up, when it's going to go down. I've got a feeling, so on and so forth. It's just too hard to do. So people might think they can time the market accurately, but everyone also thinks they're an above average driver. And I can assure you that that's not the case. I was just driving to work today, and it's leaf season here in Nashville. It's beautiful. If you haven't been here, you should come down here, but pretty crazy on the highways, I'll tell you that. So one way that we're addressing volatility and uncertainty in the markets is by diversification. That's why we keep coming back to that. That's our second pillar: building, maintaining globally diversified portfolios across asset classes, economic sectors, and geographies. And that's going to help withstand that volatility over time, because different things are going to move at different rates in different ways. So money market funds, T-bills, they're great. Like if you have a short-term defined need, like I know I'm going to have to pay my son's tuition in a couple months. Actually, I have to pay my other son's tuition in a couple months too. They're both in college now. So that would be great for a T-bill, but it's not a good long-term solution. And what sounds safe could actually be quite harmful if you end up making a big shift and you're shifting out of stuff that gives you growth and inflation protection. So on the bond side, George talked a little bit about this earlier, but I'm going to turn it over to him to talk a little bit more about our current fixed income allocation. And thank you for listening to a very long answer to a short question.
Thanks, Bill. Yeah, so a lot of talk about fixed income and where we are going, and what do we think about fixed income? What's our current approach to fixed income? Just as Sarah mentioned, there was an article in the Wall Street Journal about the current kind of environment. There was also another article yesterday in the Journal, and the headline was, the hottest investment could end up costing you. And what they were talking about is really this whole idea of, cash accounts being so high, cash value, cash interest rates being so high. And I would say that, adding on to what Bill said, cash is part of an investment strategy, part of your financial planning. A lot of the things that Judd talked about, but cash is not the investment strategy. So we think about really kind of four pieces within the fixed income strategy overall: quality, diversification, risk management, and income, right? So think about that, right? So diversification, we think about diversification, it's so important, just with stocks and equities, but just with fixed income too. So think about quality. We want to have treasuries, highest quality U.S. treasuries, but we can also mix in corporate bonds. We can mix in municipal bonds, international bonds. We want to have high quality overall within the portfolio. The aggregate bond index is about a AA rated credit quality. And our allocation overall is about an A+ rated. So we can, by adding in other investment types, fixed income types within the mix, we can get a really high credit quality within the portfolio. Which brings me to kind of the second piece, which is diversification. So the aggregate bond index is very heavily weighted to treasuries. And Bill mentioned that you're seeing pretty much a flat or inverted yield curve right now. But we want to have municipals. We want to have international bonds, corporate bonds. We want to have short-term and intermediate bonds overall. So we want to have not only U.S. treasuries, but we want to have all these other things in there too. And the reasoning for that is because when we think about the risk management within the portfolio, right? So it's a third thing. So we mentioned quality and diversification. So we have high credit quality, just about as close as the index, more diversification, and fixed income diversification is just as important as equity diversification. So the third piece here is about risk management. Right. So the way that you think about bond management, bond risk, is a concept known as duration. So we talk about interest rates going up, bond prices come down, and the measure of that is what's known as duration, roughly equivalent to years. So if you have a duration of your portfolio that was, let's say, 6 years, what that means is if interest rates go up 1%, your bond price will go down by 6%. So increase interest rates 1%, bond price goes down 6%. So if you shorten up your duration, taking less risk, theoretically you should have less downside within your portfolio. If you're taking more duration, going longer in your maturities, you're taking more risk, right? 30-year bond versus a money market, for example. We typically are less duration than the aggregate bond index. Right now, the aggregate bond index is about 6 years. Maybe it was about 6.5, but as interest rates have come up, just doing the math, the duration has come down to about 6%. Our duration is about 15 to 20% less, somewhere in the just about 5%. So as interest rates have come up, we've actually been taking less risk, and that's a real key part of our strategy. We talk about income. So that's a fourth piece, right? So income, we want to get good income and get paid while we're waiting through this volatility. And while the interest rates on treasuries are right now at 5%, they weren't. It wasn't that long ago when you were having 0%, literally 0%, all the way going out to 10 years. So how do you get income? Well, municipal bonds are paying income. Convertible bonds are paying income. International bonds are paying income. Right? We want to have good income all the way across. And sometimes it's not just the income, but it's what you keep. So if you think about municipal bond income, right, tax-free, and if you have a 4% tax-free yield, depending on your tax rates, US and federal and the state, that could translate into about a 6% taxable. So a little bit higher than treasuries. So we want to have high quality within our portfolios. We want to be really well diversified within our portfolios. We want to take less risk within our portfolios, and we want to have really strong income with the portfolios. So those are really the four key things we think about with our fixed income strategy and our approach. Talked about the Wall Street Journal article. They actually talked about cash returns since 1981. Money market funds, cash returns yielding about or returning about just under 4%. Bonds, aggregate bond index since 1981, according to the article, just under 7%. And stocks, S&P 500, about 11%. So you have to really kind of think about that. You have to have some risk in order to get return. Bill mentioned the importance of inflation protection. And we really think that having that diversified global approach to equities and fixed income is vitally important. And part of the income too is dividend yield on equities. You can get paid while you wait, while you go through some of that volatility. But that's our approach to kind of fixed income, where we still have that strategy. We have got a great team here on our investment side. We talk to a lot of managers, and our investment team does a lot of research, and as much research into fixed income as we do with the equities. So that's how I would think about the fixed income: diversification, risk management, income, and keeping credit quality high. So I think, Sarah, you've got the third question, and there was something about diversification as well. Yeah.
Yes, thank you, George. I saw this question prior to the webinar, and then I saw it come through just a few minutes ago during the webinar. So I'm glad we're going to talk about what is our opinion of the traditional 60-40 portfolio going forward. And I'm going to steal something. George made a joke about this the other day that I thought was very funny. I think the three of us must have a very similar morning routine. You know, I get my coffee, I sit down with the Wall Street Journal, and literally every other week, there's another article about the 60-40 portfolio. It's dead. Week later, it's back. So it's like a zombie. It's like it's back from the dead. And this is perfect timing because yesterday was Halloween. So let's talk about this zombie. Here we see some of the headlines that have come out over the last year about this. So people want to know, what do we think about it? Well, the reasons that are cited for the death of this traditional 60-40 range anywhere from the increased correlation between stocks and bonds. So that means that both of those asset classes will be moving in the same direction at the same time, rather than in opposite directions, which is what they have done historically. Other reasons are cited are the lower returns earned by these portfolios recently. So it is true that one of the reasons we incorporate uncorrelated asset classes in a portfolio is to smooth out the volatility and to improve our risk-adjusted returns, like we've talked about with our diversification. It's also true, and Bill talked about this, that market conditions can cause these asset classes to temporarily move in tandem, which we've seen recently with the abrupt increase in interest rates, which has caused both stocks and bonds to perform poorly at the same time. The key word here, though, is temporarily, because we don't expect recent market conditions to persist unchanged into the future. We expect a return to more normal conditions where there is a diversification benefit to owning a mix of different asset classes. So for people with an allocation to both stocks and bonds, that approach still holds. This is what Bill was just saying. The equity portion provides capital appreciation, and it's a really important inflation hedge. The fixed income portion that George was just talking about provides income and principal protection. The right mix of these asset classes is unique to each client, and it's determined by your individual goals and circumstances. Really, the only thing that should precipitate a change to this allocation is a change in your financial circumstances or goals. And to echo Judd, if you have any questions about your portfolio allocation, how it fits into your financial plan, or any number of other questions, please do reach out to your Modera Wealth advisor. And with that, that was all the questions we had today. If there's anything that came through that we did not address, we will make sure to get back to you. Thank you all for joining us. We're going to be posting a link to this recording for anyone who missed it. And again, if you submitted a question that we couldn't address either in the presentation or in the Q&A, we will have your advisor follow up with you. Thank you very much. Have a great day.